Goods sold to overseas customers. GST has to be charged on the supply of goods delivered locally, regardless whether the customer is in Singapore or overseas. MNC's export division operates as a wholesaler of food products. MNC has a related company in Malaysia, Arco Sendirian Berhad, that imports and exports food products. Arco received an order from a Singapore customer, but it did not have sufficient quantities of goods. Hence, Arco asked MNC to deliver the goods to the customer in Singapore. MNC issued an invoice to Arco. MNC did not charge Arco any GST, as Arco is an overseas company. This is incorrect. Since goods were delivered locally, MNC has to charge GST on the sale of goods to Arco. Exports. You can charge GST at 0% on your supply of goods when you are certain that at the time of supply, the goods supplied will be or have already been exported. You must have the required documents to support zero rating your supply. Generally, the following documents are required as evidence to zero rate your supply of goods. The list of documents needed to be maintained is dependent on the export scenario. Please refer to the Inland Revenue Authority of Singapore e-Tax Guide on exports for more details. You have up to 60 days from the time of supply to export the goods and obtain the required export documents. If you are unable to obtain the required export documents within 60 days, you need to account for output tax on the export of goods. MNC received an order from an overseas customer to supply food products overseas. Upon the customer's instruction, MNC delivered the goods to FC, the forwarding company appointed by the customer. MNC did not know when the goods will be exported by the forwarding company. MNC kept documents such as the purchase order from the overseas customer, payment evidence, and delivery note to the forwarding company. MNC did not charge GST when they invoiced the overseas customer based on their understanding that the goods were to be exported. This is incorrect, as MNC had delivered the goods to the local forwarding company and was not certain at the time of supply when the goods would be exported. They did not have the transport documents to support the export of goods overseas. Hence, MNC has to account for output tax on the sale of goods. Once output tax is accounted for the sale of the goods, even if MNC can subsequently obtain the required export evidence, they cannot nullify the earlier transaction and zero rate the supply of goods to the customer. If you have made errors in your GST returns, please correct the errors by filing a GST F7. For more information, please visit the Inland Revenue Authority of Singapore website.